Hello, viewers. You are welcome to today's episode. Uh, Sunday here. I'm your host for today. And if you have not subscribed to my channel or you've been getting value from all these videos that I've been dropping on how to becoming a forex trader, all right, for those of you who are aspiring to become a forex trader, please do well to subscribe. It costs nothing. And I'm urging you to please go to this website, againsfx.com. All right. Choose a package. All right. You can see that after a joint deliberation, we had a meeting and were asked to reduce price. So for the beginners, you can see it's very easy for you to take advantage of this new price. All right. The yearly mentorship is what? $200 only. Lifetime $500 only. And these are the things you will get. So you just go contact us and we will reach you so that we can train you. All right. By watching just videos cannot make you a professional trader. You need to learn more. All right. Because of time constraint, we cannot dish out everything here. And apart from that, you should understand that there are other things that you need to learn. All right, not just watching videos. By the time you come to our academy, we'll teach you everything about trading so that you can stand on your own and trade and become a professional trader. All right. All right. Today, the last video we talked about the lot sizes and how you can determine your lot size. We did say you should first identify your entry point. All right. Let's say, for example, you want to enter from here. All right. You want to enter from here. Okay. For example, you want to enter from here. Now, how do you know the lot size that you are going to use? You can see between here, your entry point, this very place here, this point is your entry point, and this is where you should put or place your stop loss below the structure, right? Okay, now what will now determine your lot size? Because I get mails every time, every day. How do I determine? How do I determine? And I've already made video about it. All right. Now I'm still throwing more light on it. This is where you want to enter. This is your entry point. All right. This place here is your entry point. All right. Entry point. All right. Now this is what? Where you put your stop loss. This is your stop loss point, right? Between this your entry point and this your stop loss point, this is what determines the lot size you are going to use. Because this is your risk. This is your risk. This one is your risk. All right? Before you can determine your lot size, you have to look at your entry point down to where you are going to put your stop loss. All right. And as you all know, as a professional trader, your stop loss must be below the structure. Where is the structure? This is the structure here. This is the last low here. So your stop loss must be a little below it. You give it a little room for it to breathe. So that is what determines your lot size. All right. This is what determines your lot size. All right. So I hope that is very, very clear. All right. I hope if your stop loss, let's say for example, the pips of your stop loss, if it is 10, that means your risk is low. But if it is maybe 20, it's going to be high. It will be different. If it is 30 pips, it's going to be different. All right. So, what determines your lot size at every given time? It's your entry, where you enter and where you place your stop loss. So, let's get that straight. All right. So that we won't be going back and forth uh, regarding that. So, today we are on chapter 7, or rather, part 7, becoming a forex trader. This is chapter 7. I urge you guys to go and watch the previous video from 1, and this is 7. All right. Get your pen and a paper ready so that we can dive into today's topic. And we have what we call leverage, because all those things you must know. Now, after this week, from beginning from next week, we are going to be taking a step ahead. All right, so you guys should prepare yourself very well. All right, we are going to be teaching, it's going to be a little deep compared to what we are teaching now, but I promise you, we are going to simplify everything. All right. So, like I said, please subscribe to our YouTube channel. It's very, very important. Go to our site, all right, contact us, all right, so that we can train you. Because of time constraint, I repeat, you cannot get everything here. All right, I believe you like a situation whereby you'll be asking questions one on one with your mentor, with somebody that is teaching you. Ask questions, let the person put you through. That is how to learn. All right. Okay. Today we are going to be teaching leverage. And what do we mean by leverage? Leverage. Leverage. Leverage allows traders to control a larger portion size in the forex market. Leverage is what enable us as a trader to take position, to take bigger position, to control a bigger portion of the market. All right, let's say, for example, when you want to trade, all right, because we are retail traders, we don't really have the capital, because before, when trading was initially introduced, retail traders cannot take position, cannot participate because of the capital that is required. It's only the banks and companies, financial bodies, they are the ones that were trading before. But they now sat down and discovered that it is better for them to give chances to other people like retail traders to be participants in the market. So what did they now do? Financial body came together, or an individual with that is well to do, a rich group of people can come together, form what we call broker. All right. So what is a broker? A broker, it's what It's a body, all right. It's a body that act between, or rather that interfaces between the retailers, the traders, and the forex market. All right. So what you do is you open an account with them. You create an account just like you going to a bank to open an account. So you choose any broker of your choice. You open an account. You create account, your own account. Then you fund the account. Now, what that is what leverage stands for. So because you don't have plenty money or enough capital, all right, what leverage does is that if you have one error, they add another one error to it that will enable you to take position in the market, all right. So leverage allows traders to control a larger portion size in the forex market, all right. Then another point you want to know is how leverage works, all right. Just get your pen and a paper and make notes. It's very, very important, and listen attentively. Then, how leverage work? This is how it work. Now, let's say, for example, your initial capital is $1,000. All right, let me use dollar as an example, irrespective of your country currency. Let's say your initial capital, when you created your account, you credited your account. Let's say you go to a bank, you open an account with bank. Your initial deposit, the amount you use to open the account is you deposit $1,000. I'm using that as an example. Now, what that does that after depositing that $1,000 in a broker's account, all right, your account with a broker, then we have what we call controlled amount. All right. Now, brokers give leverages of different types. All right. It varies. Some give, like, for example, some gives is expressed in ratio, right? Such as 100 ratio 1, 50 ratio 1, or 30 ratio 1. All right, now what the controlled amount now is that this is just how you will understand it. I made it very simple. Let's say your own capital is $1,000, then multiplied by 30. All right. Multiply by 30 is equals $30,000. So if you have an account, the money you put in your account is 1,000. Automatically, because of leverage, all right, because of leverage, what leverage does is that broker will add their own amount to it that will now enable you take position. You will not be using this money to trade. If you have 1,000 times 30, because it's 30 ratio 1, all right, now you will now be using this $30,000 to trade. All right. So their own is to collect what I have taught you people, the difference between the ask and the bid. All right. The ask price and the bid price. I've already taught us. If you don't know, please go and watch my video. Now, between is what we call spread. These are the interest they will be collecting. They will be collecting spread. That is their own charges, all right, for giving you this amount. If you are not perfect, will you be able to blow this amount? No, because there is what we call margin. At every point, at every time you place your trade, there's what we call margin. You cannot have a drawdown below that margin. All right. So that is understood. So what margin does is that you have $1,000. Then because of the leverage ratio, All right. If it is 30 ratio 1, that means you'll be having $30,000 in your account. If it is 100 ratio 1, that means you'll be having $100,000 in your account if you have 1,000. If it is 50 ratio 1, that means you'll be having $50,000 in your account, all right, in your trading account. All right, I hope it's clear. Let me still give example again. With 100 ratio 1 leverage, a trader can control $100,000 worth of currency with just $1,000 in their account. All right, I hope it's cleared. All right, let's move to another point because of time. Amplification. All right, this means that small movement in the market can lead to significant profit or losses. Now, what leverage does, because of the amount, even though you have 1,000 and what you have is 30,000 or 100,000, all right, what leverage does is that any little market movement, you are already in massive profit. But if it's going against you, you're already in massive loss. All right. So trading big account is, it has its own pros and it has its own coin. All right. It has its own advantage and it has its own disadvantage. All right. And that is what risk management is very, very key. Risk management. There is difference between trade management and risk management. I'm going to deal on that because all those ones are very, very, very important for us to get acquainted to. Okay, so once you have this amount, any little movement, you are in profit. Any little law, any little movement against you, you are in loss. So the pros of leverage, that is the advantage. It increases buying power. All right. All right. So leverage allows traders to open large positions than their capital would are normally allowed. All right, because of leverage, you can now go to for a market, financial market, and buy more, even more than the amount that you have, you deposited. It allows you to buy, it gives you, it increases buying power. All right. So the potential for high profit, all right, it magnifies potential profit for successful trader. And if you are not a successful trader, if you are not good, that means you will be in loss. That is a big problem. So the coin, that means the disadvantage of leverage is that it increased risk, plenty money with problems, all right? Because any little movement against you, you are in a potential loss. But any little movement uh, in your favor, you are in what? Massive gain. Then I touched on margin calls rather earlier. If the market moves against a leverage position, the trader might receive a margin call. Margin call is a normal thing, so don't get panic when you receive a margin call. It simply means that it will trigger when your account value drops or fall to a certain level due to your losses. If you have been making loss, it will get to a certain level, it will trigger. Let's say, for example, your account is, let me use, for example, your account is 2,000. All right. Let's say, for example, your account is 2,000 and you are having a drawdown of $1,000 or 1,005. It will trigger a margin call. All right, so that is how it is. Then the next one is risk management. Stop loss order to limit, use your stop loss order to limit your potential losses. Use appropriate leverage based on your risk tolerance and trader strategy. Educate yourself. understand how leverage works and practice using it as account before trading. Thank you so much, and we'll see you again.